Welcome to TMS Capital Insights for November. Jeremy Hook and Ben Clark bring you this edition. There's been a bit happening in the last month. One of the biggest for most of our clients will be the three banks that reported, NAB, Westpac and ANZ. Ben, how are the numbers?
Yeah, they were pretty reliably good, I thought. ANZ was the highlight, which I think was a bit of a surprise to everyone. Mike Smith was really banging the desk in the analyst conference call after, saying, you know, there's a lot of non-believers in the Asian expansion we're doing, but the numbers speak for themselves. The bank is, he said, sort of running up perfectly on all cylinders, a lot more growth to come. And you look at the number there, earnings per share up 9% with the dividend up 13%. Clearly the standout of the three banks that reported. NAB came in a bit under. Earnings per share was up 4.9%. The dividend was up 5.6%. However, Cameron Klein was more upbeat, I thought, about the outlook for the bank. So continuing the long-term recovery story there after a lost sort of decade in NAB. And Westpac, earnings per share up 6%, dividend up 5%, but they did declare a 10-cent special dividend. And I thought that was probably bang in line. So overall, there was no, nasty surprises. Our banks, as opposed to, the horror headlines you're reading about overseas banks, have shown their consistency and conservatism, strong balance sheets, and remain good parts of portfolios.
Bad debts, on the decline basically, and the banks are healthy and keep investing in them.
I think there was a slide on Westpac. They've got a $348 billion mortgage book. And they have $43 million in mortgage arrears.
Nothing.
It's 0.03% of the mortgage book in arrears.
Very strong.
Yep. And Macquarie also reported,
Macquarie
which was an interesting one.
Macquarie was interesting because it's been one we highlighted a couple of months ago as a stock we have a real interest. Its $501 million half-year profit was excellent. That was 42% higher on earnings per share versus the previous corresponding period. And it confirmed a number of things. One, the annuity style business is strong, as it has been for some time. But there's been a turnaround in their market-facing businesses. That was the part we mentioned was of real interest. So the equity capital markets, these new floats we're hearing about, some of the demergers, they're starting to give Macquarie some business, which is flowing through to profit right now. And what's good about Macquarie is they're passing it on in the form of dividends. So it was a really big increase, 33% in the dividend to shareholders. We've accused them in the past of looking after themselves and employees first and shareholders later. It seems that that's not the case right now and not for the next little while. So they've done well and they look good. One very interesting thing, in addition to the $1 of dividend, they're also distributing one share in Sydney Airport for each Macquarie Group share held. So
which is worth about $4 at the moment, $4 kicker. And that won't go ex until January, likely, and paid in January. So still some time off yet. But Sydney Airport's a business we like as well, so I guess that's a bonus there.
Yeah. No, that's good. And one key couple of stocks for us, which had a big event, was the Sol Pattinson Brickworks group. So at last, Perpetual and MH Carnegie have arrived with a proposal to unwind the group.
156 pages. It's not straightforward. So Sol Pats have actually requested and I think received approval now for a delay of the meeting or the EGM.
3 months.
3 months. So it won't happen until next year, I think February at the latest.
24th of February is the last
date.
Yeah.
And so this is quite confusing, but effectively the largest shareholder of Sol Pats, Perpetual, and of Brickworks, other than Sol Pats and Brickworks, is trying to get rid of the cross ownership with the view that there is a lot more value in both of these companies than the market is currently paying for. This is a tricky one for us because Sol Pats over the last 10 years has been such a great investment. And there is that, that sort of nice thing of thinking we could get another $4 or $5 shorter term if this were to occur. But then you wonder what sort of business you're going to find to put that money into that's going to give you the returns. I mean, I was just doing back of the paper numbers. In the last 10 years, the Sol Pats share price is up 255%. And they're paying a 275% higher dividend than they were 10 years ago. And they paid $1.16 in cash and franking credits in special dividends along the way.
And they've done that without taking on ridiculous risks. They're a very well run, conservatively managed group. So we very much like them. This proposal, though, we basically welcome. We wonder how it'll be eventually dealt with. We see it as a positive, but what we really highlight is this is a very good stock, as is Brickworks,
Mm.
and we see the value in it, and we believe the market will potentially buy this unwind. So we'll be in touch with clients in the new year when this actually materialises.
Absolutely. And there was just a final one. I just sort of recap. We sent an email to an Auckland International Airport.
That's right, yep.
We bought quite a lot of stock in it over the last week or so. If clients haven't had a chance to have a read of that and sort of work out the rationale for why we like it, please feel free to have a look at it, have a chat to one of us about it. We do think it would be a good stock, longer term, more conservative sort of share to own. But it's off to a good start already, and hopefully it'll continue.
It's looking good, yeah.
Yep.
As is the market overall, with fresh 5-year highs been hit in the last few weeks. It's looking good, and we're pretty positive about the year end here at TMS Capital. Please give us a call if you've got any questions.